Let's welcome in the Wharton School's Professor of Finance, Jeremy Siegel, also Wisdom Tree's Chief Economist. Welcome back. It's nice to see you.
Happy to be here, Scott.
Man, this is one incredibly resilient market, isn't it?
This is a market that really wants to go up. Can you believe it? We are less than 2% away from all-time highs on the S&P 500. In the middle of a war. But I like the blockade. I mean, there's some military experts actually said we should have started with the blockade and kept the airstrikes in their pocket if they acted against us. But notwithstanding, the blockade, I think, is a positive development. Also, positive development. We've heard from Axios and other sources that there were a lot of points of agreement between Iran and the United States, closer than I actually thought they might come. And has not, fired any missiles. The question will be if ships go through and they fire missiles, that will be a signal we will say they broke the ceasefire. We'll go back to bombing them. Do they want that, or do they want to go that extra foot to make a deal? If there's a deal, there's all-time highs. If there's bombing again, we'll have some sinking back. But how many missiles do they have left? How much more pain can they inflict on the Gulf? That's the big question mark, and that now is only the worst case scenario. There are a lot of better case scenarios out there.
I thought it was interesting. At the end of the show before us, they had a poll which said from 57% to 24% that the most important issue for the market was oil and the war. I would submit to you that the reason the market has been as resilient as it is because the market's been looking through oil and the war to earnings, which are still expected to be really strong. So I'm not sure the voters in that poll are necessarily matching what the participants in the market are actually doing with their hands and feet, because this market, if it was overly concerned with what they said it was, we wouldn't be but 2% from a new high on the S&P, would we?
Well, I think Tom Lee said it really well in the last session. There's where the tail risks are. Again, if Iran tries to bomb those going through and then starts inflicting major damage on the ports, on the oil facilities, then you're going to see oil go to 150, and you're going to go back to the lows of March. Again, a worst case scenario. That's the tail. The good tail, of course, is Trump says we have a deal, then we're going to all-time highs. So in terms of what's going to move the market in the big way, it is Iran. Secondly, remember, earnings are first quarter. Part of March was with rising oil prices. I think what most interesting is what the CEOs say in terms of their forecast, given the rising price of oil. But again, if we don't get much above, 425, if we stay in that region, the amount of extra money that consumers pay is not as much as the stimulus we've provided or the stimulus that the war itself has provided through increased purchases by the Defense Department. So in a way, we got a strong economy, going on. I want to see what the outlook is by the CEOs more than I want to have them talk about what happened in January and February and March. But nonetheless, the tail risks are Iran, and there's good tail risks as well as bad ones.